It's check-in time for everyone's beloved Dividend ETF SCHD. If you've held SCHD for a while, you know it's been a superstar, until recently. Over the last year or two, SCHD hasn't quite kept up with the scorching rally in tech stocks, leaving some investors wondering, is SCHD still worth it? Should I stick with it? In today's video, we'll dive into SCHD's performance, the reasons behind its slump, what's changed in its portfolio, and whether this dividend heavyweight is set to regain its shine in 2025. Recent performance, the slump. Let's rip off the Band-Aid. SCHD has underperformed the broad market recently. In 2023, while the S&P 500 and especially tech giants surged, SCHD lagged significantly, at one point trailing the S&P by more than 17 percentage points. Basically, if the S&P was up approximately 20%, SCHD might have been up only approximately 3%. I'm using illustrative numbers. That underperformance can sting, especially after years where SCHD often matched or beat the market. What happened? The key is sector composition. SCHD's portfolio is light on high-growth tech. It doesn't own mega-caps like Apple or Microsoft, and heavy on value sectors like financials, industrials, and consumer staples. 2023 was all about big tech rebound, so naturally a value-focused fund lagged. Additionally, rising interest rates made safe bonds more attractive, so some investors rotated out of dividend stocks, whose main appeal is yield, into treasuries yielding 5% plus. That put extra pressure on dividend-focused funds like SCHD. Now, the good news, 2024 has been a bit kinder. The market broadened somewhat beyond just tech, and SCHD saw relatively better, though still modest, returns. By early 2024, SCHD's performance gap was closing. It wasn't shooting the lights out, but it wasn't crashing either, just middling. One Morningstar piece dubbed SCHD a great ETF having a lousy 2024, noting that its lackluster recent run pales in comparison to its 10-year track record, which falls in the top 4% of all large value funds. In other words, context matters. Over the long haul, SCHD has been outstanding in its category, even if the last 18 months were rough. Portfolio changes and rebalancing. SCHD isn't a static set-it-and-forget-it fund. It actually reconstitutes, rebalances once a year in March based on its index rules. In early 2024 and again in early 2025, the index made some notable changes. For instance, the 2025 reconstitution saw SCHD drop 17 stocks and add 20 new ones. These changes aim to refresh the portfolio with companies that now have better combo of yield plus quality metrics and remove those that no longer make the cut. What kind of shifts happened? It appears SCHD increased its exposure to sectors like energy and consumer staples and trimmed some exposure to financials and underperforming stocks. In 2023's rebalance, March 2024, one big move was dropping some regional bank stocks, which had been hit hard in the 2023 banking mini-crisis, and adding names like ExxonMobil, energy, and Procter & Gamble, consumer staples titan. The result is a portfolio that's arguably even more tilted to value defensive now. Companies that might benefit if the economy gets shaky but could still lag if high growth momentum continues. So is this a problem or an opportunity? On one hand, SCHD's focus on value means it may continue to lag an index that's dominated by growth tech, if that narrow leadership persists. On the other hand, many analysts expect market leadership to broaden and some mega-cap tech to cool off after huge runs, and that could be SCHD's time to shine again. Additionally, if interest rates eventually stabilize or fall, dividend stocks may attract investors back, since a 4% yield looks far more attractive in a 2% interest rate world than it did in a 5% rate world. Outlook for 2025. The question, still worth it, really boils down to your goals. If you bought SCHD for income and long-term growth, nothing fundamentally devastating has changed. The companies in SCHD are still churning out profits and paying dividends. In fact, dividend growth for SCHD's holdings remained solid through 2023-24. SCHD's total dividend payout continued to rise year over year. The recent underperformance might be frustrating, but it also means SCHD's valuation has become more reasonable relative to the froth in tech. Some would argue SCHD is more attractive now going forward because it's full of undervalued stocks that could catch up. You're essentially tilting toward value at a time when value is historically cheap relative to growth. We should acknowledge risks. If the economy were to enter a serious recession, some of SCHD's holdings, especially banks or cyclical industrial companies, could face challenges and cut dividends. Thus far, that hasn't been a major issue. SCHD navigated the 2020 COVID crash without massive dividend collapse in its portfolio, for example. Its quality screens do help avoid the most vulnerable dividend payers. But diversification is never a bad idea. Some investors pair SCHD with, say, an S&P 500 ETF or an international dividend fund to spread out exposure. SCHD is heavily U.S. and value-oriented by design. Another factor is yield competition. As long as cash and bonds yield around 5%, some income-focused investors may prefer those for safety. That could cap demand for dividend ETFs like SCHD in the near term. However, keep in mind SCHD's dividends also tend to grow, whereas your bond interest payment is fixed. Over a multi-year horizon, a 4% yield growing at approximately 8% per year can outstrip a static 5% yield from a bond. Conclusion: is it still worth holding? For many, yes, SCHD remains one of the best-in-class dividend ETFs. It has a clear strategy, low fee, and a decade-long pedigree of strong results, notwithstanding the recent dip. If your goal is to generate income and you believe in the power of dividend growth investing, SCHD is still a top contender to anchor that strategy. That said, expectations should be managed. It might not beat the S&P every single year, especially not when speculative fervor is in the air. But over a full market cycle, it has proven to be competitive while paying you handsomely along the way. In 2025, SCHD could actually be poised for a rebound if market trends shift towards value, or if economic uncertainty makes investors gravitate to quality dividends. In summary, SCHD's story isn't over, it's just hit a plot twist. If you're a long-term investor, the core appeal, passive income plus solid total return potential, is intact. Just remember why you bought it in the first place. If it was for steady dividends, it's delivering that. If it was to triple your money in a year, well, that was never SCHD's game. Outro. So is SCHD still worth it? I'd say yes for the right investor, especially those seeking reliable income. But what do you think? Are you holding SCHD through this rough patch, or did you swap it out for something else? Let us know in the comments below. If you enjoyed this analysis, please hit the like button. It really helps the channel. And don't forget to subscribe for more insights on ETFs, stocks, and smart investing strategies. Thanks for watching, and until next time, stay invested.